Hello everyone, welcome back to my channel, The Tax Master UAE. In today's video, we are going to learn what is opening balance sheet, historical cost method, and transitional rule relief in UAE corporate tax. So let's get it started. Now, imagine you as a business owner in the UAE, and UAE has just started corporate tax and it is applicable for your company, and at the end of your corporate tax first corporate tax period need to file your first ever corporate tax return. But government, that is FTA, wants to know what did your companies won, that means assets, woods, that means liability, and how much is it is worth, that means equity, just before tax started. And to answer this, you will prepare your opening balance sheet, which is a snapshot of financial position at the end of your financial year just before tax starts. For example, if your first tax period starts on 1st January 2024, then your opening balance sheet will be the closing balance sheet as of 31st December 2023. And as per accounting standard uh, prevailing in UAE, that is IFRS, there are two ways to record that value. Number one, historical cost method, that means original value minus depreciation. So original value minus depreciation. For example, you bought a building for 1 million dirham. By the time tax started, it's already depreciated down to 700,000, but its current market value is 1.5 million. So if you are using historical cost method, in that case you will record that building at 700,000 only, even though its current market value is 1.5 million. And another method is fair value method, which is current price in the market. Example, same building now worth 1.5 million. So you will record that building at 1.5 million, not at 700,000. But this method is usually used only for the businesses which regularly revalues their assets, and which is very uncommon for small businesses. And there is no any problem with accounting to prepare your books using historical cost method, but when it comes to corporate tax, it becomes a problem. How? Let's understand. If you sell that building after tax starts, then your profit looks bigger because you are starting from the world lower value. That means that 700,000 only in that example, not 1.5 million. That's why sales value minus the book value. So profit amount looks bigger, and and accordingly you will pay bigger tax. That means you might pay tax on gain that actually built up before tax ever existed. That's why UAE corporate tax has introduced transitional rule relief, which fix the problem. To make the things fair, UAE has given you an option, which is also called election. When you file your corporate tax, you will see in election section transitional rule relief. Here you can choose to exclude world gain or loss from the tax. If you are, number one condition, you are using historical cost method and assets and liability was warned before the first tax period, it means before 2020, 1st January 2024. And one most important, you must make an election in your first ever tax period only. Here this condition is very important because if you are if you are not electing it in your first tax period, you cannot change it unless EFT allow it in special circumstances. So if you are choosing whatever option you are choosing, transitional rule or not, that will prevail forever. unless there is some special cases. Let's understand it with a real world example. Let's say you have a warehouse you bought in 2018 for 82 million. Now it worth 3 millions, but you are using historical cost method and you recorded that warehouse at 1.7 million, suppose. So if you sell it in 2025 for 3 million dirham, so what will be the effect? Let's see. If you are not electing transitional rule, in that case your taxable profit will be, what is the sale value? 3 million minus your book value 1.7 million. So altogether 1.3 million will be your taxable gain, and you have to pay 9% tax on that 1.3 million. But if you elect this transitional rule, you will only pay tax on the gain which are after 2024. Now total gain are divided in two parts: pre corporate tax period and post tax corporate tax period. So if you are electing this transitional rule, you are only liable to pay tax on the profit which are post tax period. And if you are not using this election, if you are not electing this transitional rule, in that case whole pre and post profit, pre tax and post tax period profit will be tax, and you have to pay tax on whole amount. That's why you, when you file your first corporate tax period, always choose, if you have any valuable assets or investment which was purchased before first tax period, in that case always make an election wisely in your first tax period to save unnecessary tax. But remember, you must declare it in your first tax return, and it cannot be changed later. Always keep it in mind. Therefore, this is the first tax period. When you are filing your first corporate tax period, always make an election. Do all the working, and then only choose whichever is more appropriate and more beneficial in your cases. And if you have found this video useful, please like, share, and subscribe. And if you have any questions or doubt, please mention it in comment section. Thank you so much.